Welcome back to your next chapter in F6 on gross income. Gross income is the basic foundation of taxation in this country. So we will have to know gross income very well. And in the Income Tax Act 58 of 1962, it is defined as gross income in relation to any year or period of assessment, which for an individual would mean the 1st of March to the end of February the next year. In the case of any resident, the total amount in cash or otherwise received by or accrued to or in favor of such resident. So, if you get income from a worldwide source and you are a South African resident, it will be included in your gross income. Or in the case of a person other than a resident, the total amount in cash or otherwise received by or accrued to or in favor of such person from a source within or deemed to be within the Republic. So if you're a non-resident, only the amounts that you source from within the borders of this country in that particular year will be included during such year or period of assessment, excluding receipts and accruals of a capital nature. So if they consider it of a capital nature, capital gains tax will be levied, but it will not be added to your gross income. If we break down that definition, the first thing that we're looking at is the total amount. And the total amount is defined as an amount that must be received by or accrued to any individual. If we do not have anything in the Act that further explains the concept, then we look at case law. And in this case, we look at two cases. The one is Latigan versus CIR, and the other one is CIR versus Butcher Brothers. In cash or otherwise, our three cases are CIR versus Delphos, Lace Proprietary Mines versus CIR, and CSARS versus Brumeria Renaissance. Received by or accrued to, CIR versus Delphos, where it says the wording of the Act states that the Commissioner may include an amount either when it is received or when it is accrued. But gross income arises at the earlier of the date of receipt or the date of accrual. It can't be included twice, so it is included the earlier of. By accrued to, we mean if you go out and earn 100 Rand and the person decides that they are going to pay you in 4 months' time, the day you actually complete the task is the day the amount accrues to you. So you will have to include that in your gross income if it falls into the next year of assessment. For receipt, we look at the following cases: Geldenhuys versus CIR, Ockberg versus CIR, Cott versus G, which was a Zimbabwe High Court case, CIR versus Witwatersrand Racing Club, and ITC 1545. For accruals, we look at the Latigan versus CRIR, the Moy versus SIR, and CIR versus People's Stores. Capital versus revenue, two important cases: CIR versus Visser and Pyatt Limited versus CIR. Remember, in terms of Section 82 of the Income Tax Act, the burden of proof that the amount is of a capital nature and not included in gross income rests with the taxpayer. So the taxpayer has to prove that. For capital versus revenue, our most important point is intention. If the taxpayer acquired and held the asset for the purpose of resale at a profit, it would be of a revenue nature, and the amount that he sold it for would be included in gross income. If it was not held for the purpose of resale, but for the purpose of producing income, then it will be a capital asset. How do we know what is capital and what is revenue? We have certain factors that tell us what it is. There are objective factors, but the most difficult ones are the subjective factors, and they call it the taxpayer's ipse dixit, that is, his own evidence will be considered by the court, but because of subjectivity, self-interest, and uncertainties of recollection, this evidence will not be decisive. Objective factors, yes, not subjective factors. The objective factors that we look at is the conduct of the taxpayer in relation to the transaction, the nature of the taxpayer's business or occupation, the frequency of similar transactions, continuity of activities, length of time for which the asset was held, the objectives of the owner captured in statutory documents, if there are any, activities of the owner in relation to the asset up to the time of deciding to sell it, any documentary evidence like minutes of a meeting, history of holding the asset or holding an asset. If you have done the same kind of transaction every year for the past 5 years, I'm sorry, but that's going to look like of a revenue nature. Circumstances of realization, treatment of proceeds, ability of taxpayers' financial resources to accommodate his professed intentions, and involvement in a scheme of profit making, if there is any. Those are the objective factors that the court will look at before they actually decide if it is capital or revenue. If they can't decide, they will go to the subjective factors and see which way that takes them. We could also have mixed intentions, which were brought up in the case COT versus Levi, alternate intentions, Overseas Trust Corporation Limited versus CIR, and of course change of intention, our very own Natal Estates, CIR versus Scott and Berea West Estates. Believe it or not, all three of these cases happened in KwaZulu-Natal. As you can see, the one in 1928, the one was heard in 1975, and the other was heard in 1976. Please remember, these dates do not mean much because these cases were heard like between 5 to 10 years after the actual incident. Natal Estates is Hewlett's. For those of you who know KwaZulu-Natal, the present Moreland Properties was the Natal Estates case. Stott, you would not know, it is Scottborough and the Bluff, and Berea West Estates is the present Westville. So those were the cases involved. Any specific transactions, you would look at a specific transaction in its entirety. You will not look at just this transaction. You would look at from the time the asset was bought, you would look at the holding of the asset, and you would look at how it's sold. Specific transaction, there are specific items which you can buy and sell which would or would not be of a revenue nature. Residence, very, very important. I'm not going to read this to you. It is directly out of the Income Tax Act. All the Income Tax Act tells us is that natural persons follow two rules. They either ordinarily resident or are physically present in the country. For ordinarily resident, we get three cases: Levine versus IRC, CIR versus QTEL, and Cohen versus CIR. The physical presence test. If you fail the ordinary residence test, then you go to the physical presence test. You do not do a physical presence test for a person who's ordinarily resident. And this test tells you that the number of days that the individual must be in the country must exceed 91 days in aggregate during the current year of assessment, and exceed 91 days in aggregate during each of the 5 years of assessment preceding this year, which we will assume is the current year of assessment, and it must exceed 915 days in aggregate during the 5 years preceding the current year of assessment. That is the end of the recording for chapter 2. We will continue the next time. Hope you enjoy your studying. See you next time. Thank you. Bye.